The Property Bulletin by London Property, the home of superprime.
Despite headlines warning that millionaires are fleeing the UK in droves due to Labour's tax plans, the data doesn't back it up. Much of the panic traces back to one report by Henley & Partners, a firm that profits from selling citizenship services to wealthy people. Their claim, around 9,500 millionaires left the UK in 2024, sounds dramatic, but it's only 0.3% of Britain's millionaire population, hardly an exodus. More importantly, their data comes from LinkedIn updates and similar sources, not official records. So if a millionaire changes their location online from London to Dubai, but still lives in the UK most of the year, they're still counted as gone. However, there is wider evidence for the decline. The Swiss bank UBS estimates that while the number of millionaires is increasing worldwide, the number of millionaires in Britain will fall by 1/6 by 2028. And worryingly, the number of billionaires in Britain has already fallen by 25% since the COVID pandemic. There are many reasons for this outflow: high taxes, anti-business sentiment, made worse by a left-wing Labour government, and changing laws which removed benefits from non-dom status. Labour supporters naturally wish to cast doubt on this point of view. They point to a poll which showed most millionaires support a small wealth tax to improve public services. Of course, it turns out that what people say in a poll to sound virtuous is different from what they actually do. In short, the rich are fleeing story is something the left wishes was just PR spin. They pretend the issue is how to impose higher taxes on what they call stagnant inherited wealth. It's just such rhetoric that scares wealthy people away. Follow London Property on all major podcast platforms to hear our 4-part series with industry leaders about what non-doms are really saying. Millions of leaseholders in England and Wales are set to gain stronger rights to challenge unfair service charges under new reforms in the Leasehold and Freehold Reform Act. Currently, service charge bills are often vague and difficult to dispute. Under the new rules, leaseholders will receive standardised documents showing a clear breakdown of charges, annual reports and admin fees. This should make it easier to identify and contest unreasonable costs. Other key reforms include leaseholders won't have to pay landlords legal fees, even if the landlord wins the case. Residents will get the right to switch or reject managing agents. Managing agents must be properly qualified. Section 20 processes will be improved to prevent surprise major works bills. These changes follow a 33.9% rise in average service charges over 5 years, now sitting at £2,300 annually, with even sharper increases in some regions like the North East. A government consultation on implementation is open until 26th of September. The UK government has unexpectedly proposed banning upwards-only rent reviews in new commercial leases through the English Devolution and Community Empowerment Bill, without prior consultation. Key points: the ban would apply to new leases, not retrospective, and cover all commercial property types. It would also affect 1954 Act lease renewals and put options, preventing workarounds. Rent could now go down as well as up at review, based on market conditions or inflation. Landlords may react by setting higher initial rents or switching to fixed increases. Rent collars and caps may be regulated, with rules defined later via consultation. Industry reaction: the move has been criticised for interfering with market agreements and lacking impact analysis. Legal challenges are expected if the proposal passes unchanged. The Bank of England has loosened mortgage regulations in a move aimed at helping around 36,000 more first-time buyers get on the property ladder each year. The changes will allow lenders to issue more high loan-to-income mortgages, loans worth 4.5 times or more of a borrower's salary. Although previously capped, banks had been using less than their allowed quota. With the rule adjustment, loan-to-income mortgages are expected to rise from 9.7% to 11% of all new lending by year-end. Sam Woods, head of the bank's Prudential Regulation Authority, called the move more than a tweak, saying it unlocked significant unused lending capacity. Meanwhile, Chancellor Rachel Reeves is set to announce a new Freedom to Buy scheme, where the government will guarantee 95% mortgages, covering banks' losses if borrowers default. This is aimed at encouraging banks to lend to riskier first-time buyers with smaller deposits. The bank also flagged wider affordability issues, noting that nearly 80% of first-time buyers lack even a 5% deposit for homes in their area. The Financial Stability Report warned of rising corporate risk due to global trade tensions, especially under the potential return of Donald Trump's tariffs, though most UK firms remain resilient for now.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the superprime property market.